Hello, and welcome to another edition in our 2017 video Q&A series with Quilter Cheviot's Head of Charities, William Reid. Today we'll be talking about the costs of investment management services. Hello William, thanks for joining us.
Thank you.
Cost is clearly a major factor in investment management, and particularly for charities, but how much of an impact does it have on the returns they're going to receive from their investments, and how much does that vary depending on which investment manager they choose?
Well, I think it's a good question. I think costs, as ever, are an important factor that investors need to take into account, and charities when looking at what they're paying for the returns they're hoping to achieve. I think at the one level, always focus on net returns, because ultimately net returns are what matters. What was the return you got after all the costs? But, and then you can compare that against, on a net basis, against the peer group, against other providers. So have they done better or worse? Then go and have a look at the fees and say, well, what did I pay to achieve this? Why does it matter? Well, the difference between paying basically 0.9% per year and a charge versus, say, paying 2% per year. Now, you might go, well, it's just about 1%. Doesn't sound like a great deal of money. But if you work in an environment historically where you've had, say, 7% annual returns, what that means is, say, over a 25-year time frame, so thinking again the long term for the charity, at 0.9%, actually the returns, 3/4 or just over of those returns have gone to you, the charity, and 1/4 has gone to the manager. If you move the tables and you go up to a 2% charge, suddenly actually it's nearer 50-50. So actually that is, that's 25% basically of that return through that 1% charge. It does matter. So be aware of that. Again, I think you look at all the various different models which are out there and the way in which you can charge for investments. You have managers that will have performance hurdles, so they have to achieve a set level of return, and then they may get either paid or get an additional payment. High water marks, that means if the manager's doubled your money this year and it falls away next year, he's got to get back to the level previously before he can start making any additional charges. One which tends to be more common in, say, private equity and in absolute return, so the hedge fund world, is a thing which is sort of nicknamed 2 and 20. And that means a manager is charging you 2% per year and then 20% of any performance which is being delivered over and above an objective. And then you have what is more commonly known in the sector and more commonly charges that we call an ad valorem fee, and that's where you're doing it on the basis of the size of the investment portfolio. So actually, the larger the portfolio becomes, typically the smaller, or the fee tapers down and reduces. And the reason for that being that obviously there is a fairly high degree of cost, a lot of it's sort of regulatory cost, regardless of how big you are to start with, and that really is why smaller charities seem to face a higher charge. It's really because of that element of the fee. But I think, again, if you're looking at charges, and again, looking at what does it mean, say, for a 2 and 20, and why is that a good or bad thing? Well, I always like to quote, and again, been shown before, that if you look at, say, in America, if you'd had $1,000 in 1964, now we've all heard of Warren Buffett, I presume, a well-respected investor involved with a company called Berkshire Hathaway. Now, if we'd had that $1,000 back in 1964, back in sort of 2015, just allowing for inflation, that $1,000 would be worth about $7,700 or thereabouts. Now Warren Buffett advises all of his, he says his friends, actually just put your money into a tracker. So one of passive fund, exchange rate tracker fund. If you put your $1,000 into that, in today's money, that will be around about 112,000, or broadly speaking. So again, versus leaving it in cash, clearly equities over long term have worked. If you'd invested in Berkshire Hathaway shares back in 1964, your £1,000 or $1,000 invested, and he'd been charging you 2 and 20, so a 2% annual fee and a 20% performance fee, that $1,000 today would be worth around about $1.2 million. So over 10 times that achieved by just going and buying the market. Obviously a very successful investor, and I presume you think that's not a bad return. I'd be quite happy with that. If actually you had put your $1,000 in 1964 into Berkshire Hathaway shares, what do you think they'd be worth today?
I have no idea.
About $15 million. So there you are, the difference between actually obviously no fee and paying a 2 and 20, which I personally think is maybe an extreme, but the difference there is that actually the manager would have made 14 million and you'd have made 1.5 million. So still a good return versus the underlying market, but compared to what you could have won, as I say, maybe not so attractive. So fees are important when you're looking at returns.
And you talked about difference of approaches and the different options available there. Different levels of complexity and different service levels are obviously going to result in different levels of charges for the end investor, in this case charities. how can they be sure that they're getting that sort of cost-benefit trade-off right for what they're paying for what they're getting?
Well, I think you've got two things. You've got one in terms of, again, I guess further regulation, but again, in terms of being able to see exactly what you're paying for, a piece of legislation which comes into effect at the end of this year, which is called the MiFID II, which will mean that actually all investors will receive a schedule annually showing in pounds, shillings and pence and in percentage terms a breakdown of exactly what it's cost them to get what they've got. And then really it's a case of going, well, do I think what I'm getting is worth what I'm paying? So you would expect, obviously, if you're paying a higher fee, does that mean I get more interaction with the manager? Do I have more meetings with them? How they invest in my portfolio? Is it on a more segregated basis? So they're buying individual stocks and shares. What benefits am I getting? What other access do I have to other maybe training, or is that just, is that offered to all? Versus if I'm just putting my money into either a common investment fund or a charity authorised investment fund, a new vehicle, should I expect to be paying a lower fee because it's less complex and there's less in direct involvement with the manager, but also, as I said, a lower fee, probably less in interaction. Again, you've seen the rise of, I guess, with passive investment, and really that being trumped as being, well, if you buy a passive fund, so that's where you're agnostic about in terms of the market, you can go and buy a fund just buying UK equities and it's just replicating or trying to replicate the market, and that is being done for a much lower fee than if you're paying for an active manager. Now, again, if you look at the moment, everyone will tell you, well, active management, is rubbish. If you look at in America, you look at the number of active managers there who are failing to outperform the index. There you are. It's a closed argument. You should just go and buy a passive fund. It's going to cost you less as well. What I would strongly recommend that people look at is, again, these things move in cycles. And yes, certainly in the last sort of 3-4 years or so, being in a passive US fund has been the right answer, because it has been a tough time for active managers, again, because of quantitative easing and other factors too. But again, it moves in cycles, and if you went back 5 years, actually you'd have had a 5-year period where active fund managers were significantly outperforming all other forms of investment and the market as a whole. So don't, if you like, it's in the same way, cost is an important component, but it is one component of it, as is the argument about passive and active management. At different times, different approaches are suitable.
Thank you. Look out for our other editions in our video Q&A series, where we talk about other factors facing charities and charity investors, such as diversification and inflation. And thank you for watching.